First one is for both of you, actually. 10 years ago, alternates was small spec. It was something that we all had heard of, but not really understood it very much. Today, it is a very integral part of how investors, large institutions, family offices are looking to allocate to. What has changed? Gautam, if you can start first.
Thanks. Thank you, Nilesh and Rahul, for having me here as well as organizing this panel. And clearly have a very good high-end guest list, if I may say so. But that's great. It's very well deserved. Congratulations to all of you once again for a lovely journey over the decade. So without much ado, I'll probably just say that, look, I think if you remember, Nilesh, that given yours and Rahul's experience over so many years, that post the GFC, and then when we had, in between that, we had the infra crisis and all that stuff. So I'm just going to step back to that era, and you had banks stepping back massively. At the same time, you had SEBI coming up with AIF structures, right? And that was the genesis of, capital moving in a different direction. At the same time, you also had post that banks just moving more and more into retail, taking away from corporates to a large extent. PSU banks had their own issues. We know the cases which were pointed out between 2017, 18, 19, etc. And that's when funds took on a much larger role. People moved, transitioned from banks. The managers of capital moved dramatically and built that network. At the other end, you had, while you had this capital moving differently into fund structures, you had this whole background and backdrop of very low interest rates and very high liquidity across the world, which helped our country also to sustain that, even though there were inflationary periods in between. And that typically implies periods of developing alternate asset classes, as the cycles used to be in Europe and US, or whoever's looked at those markets in the past, and often we are students of history, including the mistakes and the crises all along. So I think that those triggers aside, what started also happening is that you finally had a collection of, shall we call it, factors which effectively drove people towards building more in alternate assets and not just going for public listed assets. You also had funds, therefore, bringing all those products in front of you, which was never the case, to test whether it's a private credit product for mid-markets, whether it's venture debt, as you guys came up with and supported, which is a very common instrument in the United States, for example, or in Europe. Developed markets have a lot of venture debt funding. And as founders and entrepreneurship grew during this period, especially with a crop of engineers and lots of other students who went on to do very early stage entrepreneurship, you also had the demand for capital growing dramatically. So what's changed now is that this has become a norm. And I think it's structural in my view. So let's leave the interest rate cycle and liquidity aside. That's cyclical. We know that. And the Fed dictates a few things here and there. But I think now India's savers have taken on much more. So you are hedged to the extent that global flows alone don't matter. They may matter for a very large buyout fund. They still do. But they will not matter for venture capital growth. They may not matter for mid-market private credit, and so on and so forth. Because that's a role which is very permanent now that's come in. So I think I've pretty much explained the main factors that we've seen. The last part is naturally people who sold their stakes and families who exited from their businesses are now also suppliers of capital and adding to that savings lot that is, buying up different assets, and they can afford to understand and take that risk on a longer term basis. Right?
Yeah, I completely agree with you. And Aneesh, you've been an institutional investor with insurance companies. For you, how has the world of alternate changed? You've always been a big fan.
So how we started setting up or putting up our feet in this asset class was when interest rates were very low, and we had some guaranteed products where we had to give certain returns to the investors. And it was becoming extremely difficult, and that's the time when we started exploring that what are the other opportunities. I mean, equity was an asset class which would have given over a long period of time a good return, but yes, there was a huge volatility. That was a time in somewhere around 2016, 17, when Nilesh and Rahul came up and then met us. It took us almost 2.5 years to understand this asset class. And we had multiple
And,
rounds of
and
meetings.
we did not give up.
Yeah, exactly. I mean, really credit to them that these guys were so patient, always. And we used to come up with multiple questions, and they would come up and very silently answer those questions, go away, not seeing the check. And even convincing the boards at those points of time was extremely difficult. Today, I am sitting on a board where perhaps board members are well aware of this asset class. They themselves have experienced this. But at that point of time, when an insurance company investing into a AIF, which is highly risky, and with a name attached as venture, it was extremely difficult. But yeah, we took a leap of faith. Trifecta was the first fund that we did from my previous company. And this is how it evolved. But over a period of time, what we have seen is that disclosure levels, understanding, NAV disclosures or portfolio disclosures have substantially gone up. There is more, so to say, a confidence in these asset classes. Also, we have experienced them. I mean, 2014-15, we had no experience of this asset class. Today, we have a tremendous experience in last 10 years where we understand this asset class has evolved. So I suppose, and regulations have also changed. I remember at those times, documentation used to be absolutely one-sided. We are pushing AIFs to, to have more balanced kind of documentation where even investors' point of view is also incorporated in those documents. So it is evolving. It has evolved beautifully. This asset class is here to stay. There would be volatilities when perhaps if returns are not good at some points of time, investors may stay back. But this asset class has established itself. So it's a structural change which has happened. There would be cyclicalities around this structural change, but this asset class, whether it's venture debt or equity or performing credit, all these things are here to stay. And I'm sure that more and more investors would come in and join this and invest in these asset classes. Yeah.
No, and I was looking at some statistics. The alternate industry between 2015 and 25 has grown at compounded rate of 31%.
That's incredible.
And likely to compound even further in the next 10 years. So that's very encouraging. Gautam, as a family office, how do you determine the right allocation to alternates? Is it portfolio theory, cash flow planning, or is it risk appetite?
Yeah, I think you've pretty much enlisted all the three factors that go in. So it makes my job easy. All I'd say is that some things set the cap and the floor when you allocate, right? For example, you have an office, like in our case as well, which is multi-generational, right? Which is as typical. And in that, therefore, there may be income requirements and defensiveness built in based on the age. There could be risk aggression and appetite for younger, generation naturally. When you pull the capital up, you build it up on a bottom-up basis, right? For us, for example, suffice to say that our allocation since the time I've sort of built this portfolio has gone up from 5% to about 20% plus. And that includes various strategies within alternates, of course. It'll include various aspects of credit. It'll also include, obviously, locked-in products on equity, which could be, therefore, funds which are doing that, or it could be direct equity that we do, or we co-invest as well with funds, whether it is doing a private credit transaction or a private equity transaction. So I think it's a combination of these three. Ultimately, the overall risk appetite naturally caps it, right? Once you build through the, M into N of the three factors, or M into N to P of the factors that you mentioned. And we come around to that number. That's where we are.
Anish, you're on a general insurance company, so you're investing the companies surplus into alternates. There are liquidity needs, there are regulatory constraints. How do you balance this, and what kind of products you look for when you're investing the surpluses?
Okay. So obviously we understand that this is asset class which is not liquid, and hence whatever liquidity is required from the working capital perspective, that is carved out from rest of the portfolio. So we are well aware that this is long-term investing that we are doing, and then if required, we may have to dilute other asset classes instead of diluting this. So this is what broadly from the perspective of liquidity. Uh, our thought process has been that broadly we would like to create a equity AIF portfolio, and this is what the mandate which board wanted to have. But achieving that, I mean, our regulatory limits are 5% of the AUM. Currently, we are invested to the extent of 4.5% of AUM, committed to the extent of 4.5% of AUM, reasonably well committed. So our thought process was that by the time we would build equity AIFs, say in next 4 or 5 years' time, it is important that why not to invest in fixed income AIFs as well, which would continue to, because equity AIFs would not give me any income for next 3, 4, 5, 6 years. Whereas if we were investing simultaneously with the fixed income AIFs where drawdowns are faster, where I am getting returns and which is stabilizing my, at least if equity expectation is, say for example 17-18% and fixed income is giving me say 13% or 12%, so perhaps on an average we would get somewhere around 50% of that level. So income was important for us, and hence we started building in fixed income AIFs as well. We did venture, we did performing credit. So this is what broadly the thought process is. In terms of how do we allocate, obviously insurance companies are very capital intensive companies, and hence capital is extremely important for us. So what we do is that we do the risk appetite testing, and depending upon the volatility, what we have realized is that how much can be in a worst case scenario in years time, say on a 99.8% confidence level, what can be the drawdown on equity assets. And based on that, we reverse calculate that what would be the impact on the capital. And hence we say that if required capital is 1.5 times, at least 1.8 times should be maintained in a worst case scenario. So that gives us, as of now, a risk appetite of having 23% of the portfolio into equity assets, which includes AIFs as well. AIFs, as per regulations, are capped at 5%. So 5% AIF and 18%, so to say, equity and other equity assets. This is how the allocation is happening today. A little more technical answer. Once Indian insurance companies move to risk-based solvency, life would be slightly difficult because equity kinds of exposure, equity or AIF exposures, is straight away 45% of that exposure would be marked down from my net worth, and hence my solvency would be impacted. So we have to see that how things evolve over a period of time. Solvency regime would set in from 2027. Maybe that at that point of time we have to reduce certain equity exposures. We may not be to the extent of 20%, 22%. But as of now, this is what the process is, that very mechanically defined. Every quarter we evaluate that what is the max risk appetite that we can take, and within that we balance the portfolios.
And Anish, India is the only country where we have categorization of 1, 2, and 3.
Correct.
And at Trifecta Capital, given that we were kind of inventors of venture debt in India, we've actually written several notes for RBI and other places where venture debt has a very different risk profile as compared to equity.
Correct.
And so if equities were, given a certain provisioning, that should not necessarily apply to venture debt. Just for the record, we've done 8,000 crores of venture debt in the last 10 years, and our write-off is less than 1%.
Yeah, correct.
So it is clearly not the same. I mean, it sounds risky, but given empirically what we've been able to demonstrate, it's not as risky as equities. And hopefully, I'm at a panel discussion tomorrow at NISM, and the senior officials from SEBI, hopefully I'll be able to uh,
Yeah.
talk to me about this and make your life easy.
No, that would be very helpful. The fact is that today regulation prescribes 45%, but over next maybe 20, 25 years, it would move to actual experience. So if some company has a good experience of investing in AIFs and the returns are good, then obviously markdowns would be lower. So we would move to that, yeah.
Gautam, you said about 20% of your assets are in alternates. When you look at a manager, are you looking for track record? Are you looking for consistency? Are you looking for process? How, what is important to you?
So I think we'll put it between new managers and existing managers, let's say, someone who's got a track record of one cycle, fund one, fund two, and so on and so forth. Straight away, first criteria comes in is track record of what they've delivered. That becomes an overarching sort of criteria to decide whether we even want to look at it, screen it or not. Naturally, we look at the team and the process. Those factors become much more important when you're looking at a totally new manager because there is no real track record except knowing what they could have done in their, past ventures in some form or delivered on a prop book and so on and so forth. So you have to have that certified to look at whether it's a manager worth betting on or not, or someone who's delivered some investments with evidence that they are outstanding alpha with a certain style. The other factor we tend to look at often in managers is whether when they're doing fund two, fund three, etc., are we seeing a style drift? A style drift, right? More often than not, sometimes it can mean more concentrated investments. It could mean that they are, crossing over into certain investments. We don't like that. It's a clear no-no. So unless there's a, really exceptional justification for doing what they're doing, which we don't think they're exceptional at. If we think they're exceptional at doing something, stick to it. It's as simple as that. So, I won't get into numbers, but it's ultimately, the ranking changes between these three factors.
Yeah. No, makes sense. But you are open to looking at new managers, first-time managers?
Yeah, we do. Our bias is still existing managers. We do have a smaller pool which we keep within our indirect or external investing, where we try out new managers, but it's much smaller. And it starts with a small check, naturally.
Thank you. And we have 5 funds, so we have a decent track record. Anish, liquidity is an issue with alternates. So how do you design a portfolio to manage that illiquidity? And, is there some design philosophy that you follow?
So from the perspective of managing an insurance company, there is a framework through which we decide that how much of liquidity that we would maintain in the portfolio. So one is that level 1 liquidity, which means carrying the assets which are liquid assets, say for example, short-term FDs or money market mutual funds. That is level 1 liquidity that we maintain. And then level 2 liquidity is that given the historical requirement of say funds in last 6 months, how much maximum drawdown can happen on the portfolio. And currently that number comes out to around 17%. So 17% of my portfolio should be such which can be immediately liquidated. Beyond that, we have ability to take investments in, so to say, illiquid assets as well. So this is what we follow.
Yeah. Insurance companies are not allowed to invest overseas, but family offices are. There are. Gautam, how do you see the global markets and allocation from the family office to global assets? And is that something that you guys look at actively? And what could be the right, kind of proportion?
Fair question. One issue or a large constraint that sits, and you're all well aware, is what are we allowed to invest outside?
Yeah.
How much, right? And it's a burning issue with the authorities and the regulators. Some families have tried. We know what's happened. So I think that's where one of the big issues. So if you theoretically look at the question that you asked, if I wanted to have, mind you, we do have an actual allocation, a real money sitting outside which we invest, but I'll come to that later. But theoretically, to answer your question, and given the opportunity set that you see outside, and if you are able to build a skill set to do a few things and analyze funds or do directly or a combination of the two, any program should have in its family office a minimum of 15 to 20% international allocation. I know sometimes eyebrows go up with that. In some cases, some people are already there in some form due to other reasons of their past. Today, for example, we are probably in single digits, mid-single digits in our actual allocation, but that's constrained allocation. That's the problem that we sit on.
Got it. Anish, where's the smart money moving? Is it going to private credit, secondaries, infrastructure? Where exactly are you?
Well, as we see, private credit is gaining traction.
Yeah.
But if you ask me what is my desire, I would like secondaries to pick up. When I'm constrained today, if I have to create a portfolio, I am constrained by when the drawdowns would happen and when my deployments would take shape. If I have secondaries, active secondary market in India, perhaps I'm very keen. We discussed this. In fact, we discussed this issue with the board. Board is extremely delighted to allow us to invest in assets which are where we have comfort on the manager, and why not to buy it from the secondaries and create liquidity. So that is we are actively looking at.
Sure. This will be a rapid fire round. And so, these questions are for both of you. Most misunderstood alternate asset class. Gautam.
I would think REITs and InvITs are very misunderstood.
I agree. InvIT is one of the most difficult to understand.
In a good way or a bad way?
No. See, the problem of InvIT is that you are investing in an asset where it would give you defined return provided you hold on till maturity. Because many times if new assets are not acquired by those InvITs, basically NAV would continue to fall. And hence, on one side you have income, on the other side there is set off coming in towards, in terms of mark-to-market losses.
Got it. Most overrated metric, IRR, MOIC or TVPI? Anish, you can go first.
MOIC. Multiple of invested capital. Your market value divided by the book value. And it does not consider time value money. It would not consider even the cost. So MOIC is, for me.
Gautam?
I would generally go with TVPI as misunderstood. There's a lot of rigging that happens.
What is harder, picking managers or existing investments?
Picking managers, very difficult, extremely difficult. Given the philosophy that we have decided that we would back managers to the fullest extent. So my single check size today is 200 crores. Okay, so I don't want to do 50 crores to 100 guys. My approach is different. So given this scenario, I think identifying managers who are good for you, who would deliver returns is extremely important.
And, Anish takes very high conviction bets, and that's what I love about him. Gautam, same question.
Exiting.
One red flag you never ignore.
I think humility of the fund manager is extremely, extremely important for me. Why I'm saying this is based on experience. One fund manager came in, the promoter came in fund, and he says that, okay, you have invested in Trifecta. Have you seen other funds in the market? Have you seen my fund? I said, I have seen other funds, not necessarily I've seen your fund. Then he says that you are not doing justice to the work that you are doing. I said, thank you very much. He every day comes, still sits with me, but he would never get money from me.
Gautam?
So I think for funds typically, or indirect investing, we typically ensure that we look at the manager is walking the talk. Very simple. If we don't find that happening, don't get enough ref checks on that, no go. And if it's for direct investments, it's very clearly promoter and founding team. Yeah, and we've gone wrong on one. We've generally gone wrong on, let's say, only on that issue. 2 cases, I would say, but mostly we've gone right. So I think that's still an area for improvement in my view for direct investments.
Well, thank you, both of you. Ladies and gentlemen.